What is up, investors? Now, on today's podcast, we're going to be doing another doctor coaching call like how we did a couple of weeks ago. But if you haven't checked out, I think it was Brian on that coaching call. Sometimes we change the names. And I think that goes for if anybody wants to do these free coaching calls where we go into your personal financial sheet. We'll send you the blank personal financial sheet to fill out so that it helps expedite things. And people have been getting a lot of feedback that people really like to look at people's personal financial sheet as financial voyeurs is the term. If you guys are listening to this on the podcast form, go on the YouTube channel to find this podcast if you really want to follow along on the personal financial sheet and see all their numbers and a lot that we don't talk about. I had a lot of questions and feedback over my analogy that I had a couple of podcasts ago, I believe, and then go back to Brian's one for the full discussion. But this whole concept of all right, we're investing in deals. We are playing these different tax strategies, or at least learning it. Maybe getting some passive losses artificially that you don't have to recapture through the new tax PAL fund. And you're doing a little bit of infinite banking or our new accredited investor banking, which you guys will probably learn as we roll that out this year. Let me know if you want to try it out. But it's working. But all right, people are moving down this path. And I think everybody here pretty much, they're not trust fund kids. They made their own money and they're still working hard in their jobs or as 1099s or their small businesses. And what is the path forward and how do they keep working? Do they titrate down? Do they work? Do they spouse work? How do you implement rep status? And I introduced this Toyota or Ford Raptor gas guzzler versus the Tesla model versus the in the middle hybrid Prius model of kind of different paths to doing this. Of course, all this is personal finance. And what I really urge you guys to do is sign up for the club if you haven't. And even if you're scared, book that call with me. I won't rip your head off. I'm really nice when you get to know me. We get on one-on-one and, let's go through this and let's see which one of these paths really fits well for your family and, or at least give you what the options are. And let's try and compress time cycles for you because time is really the most important thing out there. But if I'm not going to go into what the heck this analogy was, but what I'm going to say is go back to the previous podcast that we did, coaching call with Brian. He was also a doctor. I go over this loosely. If not, shoot us an email. Maybe we'll do more. But certainly if you're on the YouTube channel, put a comment below with answer. But this kind of there's real quality of life questions and personal finance questions. And this is ultimately what I really like because this changes lives. So like going into a deal, doubling your money, whatever, that's cool. Tax savings, yeah, that's amazing when a lot of the doctors will save $150,000, $200,000 in their first year by doing some of this stuff. And, of course, that's if you guys heard my kind of confession last week. Sometimes when you have a lot of money, that may not mean too much. But, when your net worth is under $1 million, a couple $1 million, this is big life-changing moments and maybe can be the difference between you having a second child or third child or even kids at all, or even going down a different path in life, whatever you choose. But again, go check out that older podcast. If you have any questions, let me know. Or if you haven't burned up your free intro call with me, I urge you guys to let's get you guys going, or at least get you a different viewpoint so you don't just screw around for the next 30, 40 years of your life, putting your money blindly into the stuff that they want you to do. And enjoy the coaching call.
This is a story about a dude named Lane. And then one day he went to try to rent them out, and then he became one of the best of men.
Hey folks, we have another hardworking professional who's going to be volunteered to do a coaching call here. So Derek is a doctor, and if you guys you guys really like this. I don't know why. I think people get like financial voyeurism when they peer in on these things. But the truth is there's not too many different profiles. And if you've gone to the YouTube channel and look for the coaching call playlist or gotten access to our members portal, which is free. You just got to sign up at simplepassivecashflow.com/club. We actually align all the coaching calls based on net worth. So you can just find yourself and fit right in and find some of the past coaching calls, people of a lower net worth than you, and some of the higher ones that you'll get to at some point. But dig in here. Derek, thanks for doing this. Why don't you quickly go over a little backstory get to know you a little bit.
Sure. Yeah. Thanks, Lane, for having me. Excited to do this coaching call. As far as my background, so typical working or professional kind of investment background. I met my wife in medical school. We were both physicians and busy with training and residency and all that. So we just went down the typical route of basically doing retirement accounts and funneling all our money into stocks and bonds. We thought we were pretty smart because we were doing mostly low fee index funds. So we weren't picking individual stocks. We were doing a lot of just basically Vanguard mutual funds. And we're doing that for basically 10 to 15 years because we had 2 children along the way. And then just recently, actually earlier this year, brother-in-law got me turned back onto real estate. So I went down a really deep dive into the podcast world and Bigger Pockets on your podcast, and really just started to look into the syndication space and rental property space. And this year we actually purchased 2 rental properties. So one that's for a long-term property where we actually have some in-laws staying in it. So it's not like a typical rental property, I would say. And then a second was a short-term rental property that we got in the mountain area in North Carolina. So we did all that this year. And then now I'm at the space where I really want to start more looking at truly passive, so syndication type deals, and maybe even starting to look into like infinite banking. So basically just trying to get more sophisticated away from just mutual funds, stocks and bonds, actually start getting some more investments into the real estate space.
And then where are you guys at age-wise? You guys got kids?
So I am 40. Unfortunately, the other complicating factor of my personal history is my spouse passed away suddenly like a few months ago, which complicated the issue. So it's just me now as a single father with 2 kids who are 6 and 9. That has also led to this push very recently to really try to simplify my life and simplify my investment strategy. Obviously, I want it to be high yield and useful, but I just really want simple.
Sorry to hear that. I know it's something that all of us, as we're trying to get our stuff together, we never know what's going to happen. Could be you, could be them. I was kind of thinking the other day, if it was me, what's the point if I'm gone? It's all done. The simulation ends, but that's not a good way of looking at it. But yeah, I mean, let's definitely get you on the right path, or at least tell you what I think. And
great.
But right now you're still working, right?
Yep, I work full-time, W-2. I know I've listened to a bunch of podcasts, yours included, where there's talk about like real estate status professional and all that. I'm not going to qualify for that, and that's probably years off because the place I work at is actually a pretty cool place. It's a fun startup, and I'm definitely, I think, going to continue it at least for the next few years. So I don't really have that's not in the immediate future to shut off my W-2, if that makes sense.
So just a quick snapshot for people listening on the podcast. We also do this via screen share on the YouTube channel. So if you guys want to flip through some of the personal financial sheets as we go through, I'll hop on over there later. The net worth, about 2.5. But what I wanted to dig in on, so assets first, right? You mentioned a lot of it is just traditional stocks, bonds, mutual funds, etc. So what I'm seeing is about 800 grand in that stock, bonds, mutual funds stuff. And then you've got a lot of equity in the rental and the primary residence that you guys live in.
That equity might be wrong. I might have filled out the sheet wrong. So the equity is probably in the primary residence, I would say between 300 to 400, depending on what it's going to sell for in the market. And
no, you did it right. You did it right. You have this is what it's worth now. That the delta is, this is the mortgage on it. So I think you got it right.
Yeah. So 300 to 400 probably in my primary, and then the 2 rentals were just purchased within the last 6 to 8 months. So the equity in that's definitely not quite as high. Although with the market, it's probably somewhere between 50 to 75,000 for each of those.
Okay, so we'll circle back around on like we're going to invest, what money we're going to use first in what particular order, which is always a very common question that comes up. But let's figure out your velocity at this point. So what is your kind of your adjusted gross income? What do you guess it's going to be this next year?
So right now, my wage is $265,000 per year, wherever that comes to after taxes. It used to be with my spouse working as well, it was closer to $500,000, but that's obviously going to change.
And then your expenses, right? You're not cheap having a couple kids, but luckily you're not in the wonderful state of California, a little bit cheaper where you're at.
Right. Yeah, North Carolina is not too bad, although the area I'm in is a little bit more expensive than the typical North Carolina, but it's definitely, yeah, I've lived in the Bay Area before too. It's not like San Francisco, other California areas.
Yeah. Did you move over to the Carolinas for work or
Kind of for family. So I used to be in the military. So we were in California, then Colorado, which I actually really loved. But a lot of my wife's family is from the Northeast area. So we just wanted to get closer to them, but didn't want to go to an expensive New York or Massachusetts area. So that's how we ended up in North Carolina.
Okay. So what would you say you guys monthly burn rate for expenses? Utilizing daycare or
Yeah, there's after school. So our kids are in school, but we have to put them in after school or after care. My wife has some car payments because she got a new car a couple of years ago. We have our mortgage, taxes, groceries, all that stuff. It's probably around 10,000, give or take 10 to 12,000, depending on the months. I used to track the budget a lot more closely, and then that kind of went away last year.
Yeah.
So that's probably about it. And that's including like we would set aside money to go on nice vacations and stuff like that. We bump that in. So probably 12,000 a month would be.
Yeah, and I think this is 12,000 burn rate every month, and you net about 10. So you're netting at least 100 grand a year. Maybe if that'd be a couple of investments every year. As long as you can stay above 50, 75,000, I think you're good enough. You can let off the gas a little bit. Whereas some of the folks that are under a million, 1.5 million, they might want to tighten the belt a little bit. Going at a pretty decent clip here. It's just a matter of being smart to where putting the money.
Yeah. I think that's my next big step, is just being smart with deploying all the capital I have, for sure.
Yeah, I'm not a big personal finance guy anymore. Saving, flipping coupons, that type of nonsense. But you guys are doing pretty well. I've talked to some people in California where they make more than you, yet they're barely able to save $30,000 to $50,000. And I'm like, dude, what's going on? And it's typically private school for kids is what clips that up, or extremely big house. But I think your house is pretty big for North Carolina. You got the salary to support it.
And that's actually something I've already been in the process of looking at. I put an offer in on a townhouse that would be smaller to downsize. Like, I'm already looking at a way to either do a cash out refi or just sell and downsize. So I'm actively looking to do that and pull the equity out of this house.
Yeah, let's do this. Let's go over the deployment strategy first, and then we can loop back around to like kind of life choices or transitions. Maybe I can just be a sounding board for you, because at this point, I know you're going at a certain rate, and I know where you're going to be in the next 4 or 5 years. And most times, I think you folks, and myself included at one time, you operate as in scarcity mode, right? We think we're not going to be able to get there, so we're pinching pennies. But if we make the right moves, and especially if you want to downsize, that gives you a lot more, pushes you further down on the financial independence road. So that said, let's talk about so let's look at this 800 grand in your retirement account. So you got it broken down, one of these sheets, IRA versus Roth, right? I think down here. So let me see here. You've got the Roth stuff is about 150,000, 401k, 403bs. That's the majority at 550, and then you've got the IRA miscellaneous stuff at 990. So
one thing I've looked at, or I've reached out to a company, I think it's like EQRP or something, was like one of those trying to tap into specifically that 403b that is my wife's. So now I was the beneficiary, now it's mine. So I'm still trying to look into if that's something.
Yeah, everybody's trying to sell you a bunch of stuff, huh? Yeah. All right. Here's my thing. Retirement accounts, you've heard me say I'm not a huge fan of, like, I think you're better off paying your taxes on it today while you're in a lower tax bracket today. Look, you're at 250, you're under the 340, right? And then especially if you believe taxes are going to be going up in the future, especially if you think your financial picture is going to be going up in the future, that argument were to put it into these self-directed accounts or qualified retirement plans is what they're technically called, not some marketing term or whatever. They're all the same thing. Solo 401ks. That works if you're investing in non-tax advantage things, right? Like crypto, stocks. But if you're investing in real estate, the damn thing should be tax-free anyway, because you get the losses from the tax advantage asset. That's the key thing that people glaze over all the time. So I guess my first question is, are you going to be investing in real estate or You want to be investing in stocks, bonds, mutual funds, crypto.
So I'm still trying to figure out like what I ultimately want my asset allocation to be. I know that I want to like currently I'm very heavily in stocks and bonds, and I want to shift that and probably get anywhere from 40 to 50, maybe 60% of my total net worth in real estate, probably 20 to 30-ish, and still stay in stocks and bonds, index funds.
Okay.
The crypto piece is the one that I'm still figuring out. I actually listened to one of your webinars that you did. I forget who the person was, where they were making the point that he thinks Bitcoin is going to be worth however many million per Bitcoin and all that. And I have some friends that are pushing Bitcoin hard as well. I've gotten a tiny bit into that space. It wasn't anywhere on the worksheet, but I think 10,000 crypto. So I'm like dabbling slowly in a little bit of Bitcoin and ETH, and I'm trying to determine, is that going to be like 1% of my net worth, just so I have a tiny stake, versus 5 to 10%, and I'm a little bit more aggressive in the crypto space. So I'm still doing a little bit of research on that.
Yeah.
Allocation.
And that's what makes this hard, right? Because before we start to decide on self-directed IRA, solo 401k, or take it to cash, you got to figure out what that end asset allocation pie chart's going to look like. But you don't know what the hell that looks like at this point. Like I have some ideas. I'll just shoot you what most people in our kind of mastermind group will do at your network. They might do like at most 5% into crypto. The crazy ones will be doing 10%. But as you can see, you're not going balls to the wall with this type of stuff. This ain't Wall Street bets type of stuff. So
5 sounds a little bit like more reasonable to me.
Yeah. And then most of them, they start off with that 50% alternative asset idea, which I think you're hitting down. Over time, I think that it creeps over to the majority. But I think most people, they're always going to have a quarter or a third of the traditional garbage, if you will. Personally, I don't have any of that stuff, but I'm not normal. And I think it's prudent to have some of that stuff so that you're always in it, so you're learning. So the idea is you go to alternatives, get your net worth up to 5-10 million, and then possibly come back to the traditional space is the idea. But if you leave the traditional space, you might as well stay on the alternatives, because that's what you got you there in the first place. But let's just go with, you're going to, in the next several years, you'll transition to half alternatives, half, 45% traditional stuff. So we'll leave half of this stuff alone, in a way.
Okay. And are you counting like syndications as alternative?
Yeah, those are what I call alternatives. Yeah.
So
real estate is alternatives. Crazy.
So I might actually be more comfortable with 65% alternatives, 30% traditional, 5% crypto. That seems like a reasonable starting.
Yeah, and I think that's very typical of the people in the family office group that have that kind of mindset. But of course, you got to get to your 50-50 first. So let's have that to be an intermediate goal these next few years, and then get to that once you get proof of concept. But that in mind, of course, I'm aggressively pushing you to, move this stuff around. What I would probably do in that case is, let's see, again, 800,000 of various pre-tax, post-tax, various IRA, 403b, 401k stuff. First thing we always do is we don't touch this stuff first. You got liquidity, right? You have home equity first.
Yeah, so I have home equity, and then there's a decent amount that I have in checking and savings, and then also I got a lump sum for the life insurance, a supplemental life insurance benefit. So what
would you say like that liquidity would sum up to about like several hundred thousand?
It's about 700. Although I like to keep some in reserve. Like I'm one of those people that probably wants 75 to 100 in my account.
Yeah, fair enough. Fair enough.
So deployable capital right now, I would say comfortably between 6 to 650 that I could deploy pretty quickly.
So there's two ideas I'll give you. Like first is what I'll do, because I've already know it works personally. And then there's the one that most people will do that I see, which is obviously takes into account the whole, let's try this stuff out first before we go crazy with this stuff to make sure it's real. Let's get proof of concept. Call me crazy. Like when I started to do out-of-state turnkeys, I bought one property first, then I bought 11 very quickly. But I think it's prudent to get proof of concept. Although we've had people invest $1 million in 9 months by joining the family office group and building relationships with other peers, and then quickly moving in, which makes me stressful for them. But now they're happy with 5 figures of monthly passive cash flow now, 2 years later. Those are the two goalposts to think about.
I mean,
but let's
I would say normally I'd be more on the cautious side. I think the one thing that makes me think I might be a little bit more aggressive about deploying the capital is just the inflation that's already here and seems like it's not going to slow down. I don't want to just sit on this pile of cash for 2 or 3 years and have the purchasing power.
Yeah. So those are the two goalposts, right? So what I'm going to propose, just so we don't have too many things floating around out here, is just the bare minimum conservative one of moving in slowly. So what I would do, so there's 3 things going on here that I'm thinking in my head. First, we got to deploy the liquidity first, because that's the stuff that's not doing jack for you. Then what I want to do is I want to leak money out of these retirement accounts slowly, so that right now your adjusted gross income is about 250. What I want to do is you're married, file, single now.
There is some sort of, I think I can technically still file married jointly for the next 2 years, I believe my CPA
Okay.
said. Yeah, and that was the same that's part of the reason too why I'm thinking of selling the house. He said it was like 24 months. After she passed, I think I can still get the full $500,000 free when I sell the house versus the 2.
Okay. That's fair. That's good. So here's what I'm thinking. Say that is the case, right? If you're making 250 and then you leak out the retirement fund slowly to take you up to this 340 number about, right? So you're taking $100,000 out every year for the next couple of years. If it's unlucky where you don't get that treatment, then you're already topping out at the higher tax bracket, right? So does that make sense? So you're gonna have to walk this path down the road with your CPA.
Okay.
But the idea is we want to be leaking out our retirement funds as quickly as possible, but not to go over this red line here. That makes sense. You understand the logic?
Yeah, gotcha. And is there a rank order of how you leak those out between the retirement accounts?
Yeah. Good question. But let me get back to that. So the one thing, the Roth IRAs you've already paid the taxes on it, and you can take out the contributions tax-free, penalty-free. So that's you could always be taking that out in a way. But you have so much money liquidity-wise that you don't have to touch this probably for the next several years.
And like I said before, I'm still considering keeping a quarter to a third in stocks and bonds. I could.
Yeah, for you, and this is very personal for your situation because you have all this other liquidity and this. I would probably leave the Roths alone.
Okay.
You probably don't have to touch them. So to answer your question, your current one, your 401k with your current employer, you probably can't touch that. So let's just leave it alone. The next one would probably be the 403b from the previous employer, your spouses, or this IRA. Probably do the 403bs because my logic is you have crappier options with your IRA. You have a bit more choices with it. And these are typically more of a pain in the ass to manipulate. So let's get it out now. So I would say, let's just put a number here. First would be this would be the first year, because if you're going from 250,000 to try to do this year, if you can, there's a couple more weeks left. But
I still had my spouse's income for most of this year, and then they also paid out like some months for.
Oh, okay. You're already topped out.
The income for this year is going to be well over $500,000.
Okay.
But it's going to be married filed jointly. So next year is really when the salary is going to drop to that 265 for just me.
Got it. So yeah, let's earmark that for 2022.
Okay.
And then we chip away at this 400, 2023, 2024, 2025, and 2026.
And is the thought that I'm just slowly drawing it out, stay below the next highest tax bracket, and then redeploying the money into like syndication deals?
Yeah. Of course, people will tell you these are the best thing. You're gonna have to pay the taxes on it at some point, and you're not getting the tax benefits today.
Yeah, that makes sense. Okay.
And then the 401k would be I'm thinking you're probably gonna quit your job before 2027. So probably get
Probably, yeah. The place I'm at, it's like a startup, and just the trajectory of it. Like, I think the interesting work will be done by then, hopefully.
yeah, actually 2027 with IRA and then 2028 for this later. You'll probably come to a couple Hawaii retreats by then. You'll probably maybe do a backdoor Roth at that point. A lot of this will change in the next 3 years. Anyway, but let's get you going down the path first. And I would probably recommend against the only reason where it might make sense to do a qualified retirement plan is if that doomsday scenario where you are limited to single joint or that 170 max, then you might again, for people listening, the only reason that stuff makes sense in my own humble opinion, I'm not a tax attorney, but there's no right answer for this stuff, as it is if two things apply. Number one, you're already in tax bracket, highest tax bracket, which you are. And number two, you have a boatload in your retirement accounts, which you do. Like, I've seen people with more, like $1 million, $1.5 million in their retirement accounts. You certainly have more than $500,000, 600,000. So that kind of satisfies that. And the reason being is, oh shoot, what do we do? Let's just kick the can down. It's punting in football, right? In a way. Unfortunately, and the things you have to balance, and the reason why I'm not super keen on is these damn things cost a lot of money.
Yeah, I like your plan. I'm slowly drawing this out, as noted. And then you did mention like the backdoor Roth. So that was something we had been doing the last couple of years with my spouse. I didn't do it this year, but is that something you typically recommend for?
For most people, no, because they got to get their stuff together and get their cash flow bucket filled today. Then when you're already cash flowing $10,000, $20,000, then yeah, do your backdoor Roths after that. People do it all backwards, which you're seeing. So you have that general idea, and it sounds like you have a pretty good understanding of leaking things out. If that would be the conservative way of doing it. If you wanted to be a lot more aggressive, you take it out 2 times as fast, and you start to supplement with some other more exotic tax strategies and stuff like that, like land conservation easements, that type of stuff. And then I think at that point, it probably makes more sense to join the family office group, talk to other doctors doing that type of stuff, see who are the operators that they've been working with. And at that point, we're going to save you 10 times as much as your initiation fee for a group like that. But again, that's not for everybody, right? I think you have a pretty dang good, like, conservative middle of the path strategy right here that you could probably implement. But if you want it to be optimized, that's the way you go too. And then you can unlock all this money and get it deployed right away before the Great Recession happens.
I do have a question about the infinite banking concept, which I know you've mentioned on some of your podcasts and like webinars and stuff. Is that something I should consider with starting one of those policies, since I do have so much cash that I...
Yeah, and that was the other thing I wanted to... So that's always, people always geek out on infinite banking. And then if people want to, I would always say, check out the free infinite banking e-course we have. You got to sign up simplepassivecashflow.com/club, or I think if you go to simplepassivecashflow.com/banking, you can sign up directly for just that e-course. But it would probably make sense in your position, because you have so much, that you have that 700,000 just sitting there. Right. And it sounds like you're on board to leaking out your retirement accounts quickly. So here's how I would like mind model this thing out. Like 2022, so I start to build these like timeline deployment plans, and then model out how much liquidity you have. So right now you're starting with 700 of liquidity. And this, let's just say this line is like how much you're going to invest. How much money you think you're going to invest in 2022?
I guess it would depend on how comfortable I am finding syndications and betting.
Yeah, I'll say like most people, they'll do at least 100, 200,000. Again, I've seen people do $1 million in the first year. So those are the two ends of the kick the football.
Yeah, I think I'd be comfortable anywhere between 200 to 300, depending on whether that's $200,000 deals or a few $50,000 deals.
Okay,
yeah, so it's probably a good number to put on that. Yeah.
Yeah. So what I'm doing here is just now I'm figuring out how much liquidity you're going to be left with, and let's just say you go with the same thing in 2023. You're going to have 200, but you're also leaking out. Remember, we're leaking out 100,000 each year from IRA. I think I got all my roles messed up here, but
I see what you're doing.
You're going to have 300, right? Yeah, no, you're going to have, okay, so they do that. You're going to start off with four. Yeah, if you have 700 and you invest that, now you go down to 550. And then you pull out another 100, but you invest that. You're basically going down by 100,000 each year.
Or down 150 a year, investing 250 and pulling out one. So
maybe this year you get really
aggressive.
You go crazy on this year. You go 300, but you're still.
Yeah, like I see what you're doing. This makes a lot of sense. Like then I get more comfort investing in these deals. Know what better deals are.
This is why I like working with smart people. You guys catch on to this stuff. It's so frustrating. What does that mean? Bang my head against the wall if I can't. I'm not a good communicator, but this is what I'm trying to do. So you're gonna invest another 300 this year. I actually think what we'll probably do is in these years, you might even 2x this investment. Probably was going to happen, but
I think you're probably right, because I'm really starting to lean into learning more about this, and I'm strongly considering like joining your mastermind group and really getting a strong network of like good syndicators and understanding the space.
So
more comfortable.
Let's just bump it up a little bit, 350, and I think that went to 350. Let's just say you do get a little bit more aggressive, like we're saying. That was 350, 450. I think that's how it is. Okay, so you're gonna basically burn through your cash liquidity in 3 or 4 years. So what I'm trying to do is I'm trying to model out how much cash liquidity you have, and then how much. So it's two things. This is just real general rule for how much money should I put into my infinite banking every year for 6 to 7 years. So my general rule is take 1/3 of your annual debt. So for you guys are saving 100 grand a year. So that's 330,000 or 33 grand every year. But you have a big amount of liquidity, which we've modeled out and estimated on this line what it's going to be. What I want to do is estimate. I want to utilize this so that by the middle of the policy, you should be using this up as best as you can. So this is where I'm just shooting darts out there into the universe a little bit. But my gut tells me that I'd like you to put in at least 100 grand because that your liquidity is so high. So I would say on the low end, 130 grand every year.
130 grand every year. Okay.
Yeah. But you want to know what I would do?
Yeah.
So this all depends how you create the policies, how much commissions the agent wants to take, right? So you can crank down the commissions, and what that does is cranks down the life insurance portion. The 10 to 20% is the best practice. If you don't want to gouge their clients with commissions, which most people do, it's like a 50-50 split. The other good benefit to doing that is you don't have to. You may sign up to do $100,000 a year, but only $10,000 is really what you have to put in that year.
Right.
So that's the beauty of it. And that took me like 3 years to latch on, because out here, you and me are good citizens. We're like, if we say with a life insurance company, we're going to put in 200, shoot, we have to put in that every single year for 6 years to a total of 600,000. But in reality, all we have to do is put in 60, maybe 100 grand, and shoot, we've hit that in the first year.
Yeah, I have been in talks with somebody who does this, and I forget what once it's topped up to 130 or whatever, you're done. The policy's self-sustaining.
Yeah. And as long as you hit that, if it was a 90-10 split with 10% of it being insurance premiums, once you hit that, you're good. You don't have to worry about the policy cannibalizing. For the longest time, I thought, oh, you got to put in the whole thing. Not necessary. But if it was configured in a jacked up way where it was 50% of it. So on the 600,000 fully commit policy for 6 years, 100 grand every year, you have to put in 300. That's a bigger nut you have to keep funding as opposed to 60.
So it sounds like the more important number on these is basically what's the total amount I need to put in to get past the point where it can cannibalize itself, like where the fund is self-sustaining. And if I stop funding it, I'm okay. The policy's still at least there.
Right. Ideally, you want to create the biggest container size without losing said container.
Got it.
So
Yeah.
for you, you could probably, you have, if I just add up this line here, or I mean, you're going to have it, I'm just looking like on average, you're going to have maybe 50 at time. Again, this is the low end, 130 every year. You know what? I would just get a max $10 million policy. So $10 million is a important number because at that, if you go higher than that, you got to show a whole bunch of BS documentation
Okay.
to get higher than that. And really, you don't really need more than $10 million because $10 million typically is a payment of $250K for 6 or 7 years. I would just, again, this is just what I would do, right? This is more of an aggressive way of doing it. I would just start off with the $250K a year, and then you fund that. Maybe you backdate it if you're depending when your birth date is, and you fund that first 2 years right away. Or worse, probably what's going to happen, you go 250, and then you go 250, and then you start to just fund the insurance premiums from there on out. But you've already hit your minimum amount, so it doesn't cannibalize in your first year. So you're good there.
Right. Yeah, that kind of answers a question that I had just jotted down to ask you, which is like, where am I going to park my money now? Because obviously you don't get anything on savings or CDs, and I have to open a bunch of separate bank accounts. I'm not above the FDIC limit. So I kind of this option, if I can fund those, basically double fund and deploy some of that capital, that fund's taken care of. And then if I put all that money in pretty quickly, then depending on how the policy is written, from my understanding, within anywhere from a month to 6, I should be able to start borrowing a decent amount from that policy to put into syndication deals, correct?
You can do it the next week, get the money back out next week. So this is,
sounds like a good plan then.
this one's funny, right? Because it operates like a HELOC account, but it's still like people, even in the mastermind group, they're, I got to pay interest payments to myself. I don't want to that stresses me out. That's $400 a month. No, that's just a mindset thing. You got to get over that. It's just, what the way you're supposed to use this thing. If you put in 250 and now your cash value goes down to 200, and then you put in the next 250 the next year, maybe it's worth 450. Let's just call it that the next year. What you want to do is you want to take out that 450 and put that into deals or crypto or whatever.
I'm assuming you guys have good contacts for these infinite banking.
Yeah. Just go through the e-course. And then I would say it's a couple hours for do that e-course, but it should get you set up. And then, we can refer you out from there once you're kind of studied up. But they're commodities, right? They're all with the big major companies. That's really what you want. But the question is, where are you going to put the money? And that's really up to you. You can put it into deals. What some people do is I think a mistake that I see, especially for somebody in your case, is like they want to leave their dry powder in here and only take out half. Like that, dude, that's not what this is for. You got to take it all out. Unless you're a business owner that needs a lot of dry capital for yourself, 20, 50 grand in checking. 50 grand's way more than you need, but 20 grand just to float your monthly expenses every quarter. And then maybe 50 grand to leave it in here. So you deploy 400 in this case. Like that's really the way you want to play this. And then if you want to do 300 of that 400 in deals and then 100 in crypto, that's how you do it.
Okay. I hadn't even looked at infinite banking for crypto. I was just looking at it for syndication. So that's good to know. You
can use the money to go to Disneyland if you wanted to. Obviously, you're not going to do that. People who listen to this podcast, don't do that stuff. Or you could use this as a way better than 529 plan.
Yeah.
Hell of a lot better. I don't know why anybody does a 529 plan.
Oh, I even forgot to put that down. We do have 529 plans for our kids, but we shut them off, I think 6 months ago after listening to your podcast, and other ones like those have been shut off. Yeah. I think they each have 10,000 in it. I'll probably just
just shut them off because I would just withdraw it just for simplistic reasons. Today I was trying to get rid of my health savings account because I got like 15 grand in there, but it's like, what a pain in the butt to have this thing, and I got to pay them $300 every year. Like really, that 2% adds up all the time.
Yeah.
300 grand on 14.
Do you have any thoughts about the lump sum, what are they called, MEC plans, or like for infinite banking, like the life insurance policy where you can do the lump sum instead? I spoke to somebody the other day and they were like, oh, some of the drawbacks are that I think it was if the distributions were not taxable, I believe. versus in the other one they are. There were some differences with it, but I had never even heard of the lump sum thing until I spoke to somebody. I don't know if that's something.
Yeah,
you've
you're
already
gonna have to
explored.
talk to our experts on that one. That
Okay.
just there's all these kinds of other like variable life. That's like they miss the point. They're like, don't you want higher returns? We're like, no, we want like liquidity so I can go invest in better stuff. I don't need 6-7%. And once your net worth goes over 5-10 million, then you may come back to that type of stuff. That's I think when it makes more sense. But there's a lot of shady stuff, especially in like IUL. People's the commissions on that are extremely high. There's a lot of aggressive salespeople running around doing nonsense for that. There's some companies actually like really aggressive on teaching the agents. They have this like farm school where they teach people because it's such like a obscure product with high commissions that it makes sense to just train trainers or just make real estate agent armies, you know, head out there. 1 in 100 will actually sell a policy, but it's pretty good commissions for them at the end of the day. But basic IPC, this is what it's for. Once you go over 10 million, I think that's a little overkill. But especially because you want to get this money working at 4 or 5% tax free. And then
Right.
Another thing to think about is because you're the only one for your kids now, I mean, it would probably be prudent. A single point of failure at this point.
Yeah, that's true. That is another good benefit of opening up one of these. Yeah.
And that's it. You guys, you have a trust build and all that stuff, updating.
Yeah, I'm in the process. I got to redo. We were in the process of getting it set up, and then my wife passed away before all the stuff was notarized and finished. So it's a little bit of a mess. So I'm trying to get all that sorted, and then I was obviously not in the right state of mind for quite a bit. So I'm finally getting my brain back from brain fog, and I'm going to start cleaning that up.
Yeah.
2022. Yeah.
I think that'd be good to talk to other people too. I mean, the questions on like, well, who watches your kids? I'm not giving any advice on that. And this type of, you know,
You want to
I
watch
don't
my
know.
kids?
No, I wouldn't even trust myself with my own kids. I mean, but yeah, these questions come up and it's hard to find other people who are doing the same thing. Yeah, you technically just listen to your attorney, but I don't know if that's super prudent. I need other viewpoints too. But getting back to the numbers here, if you do that large of a policy, once you fund it up to, you have that 500, 300,000, you're going to fund it halfway. That's well past the point that it's going to collapse on you, a black hole on you. So you're good. And what's probably going to be happening around year 3, year 4 is these deals are going to start to refinance early, full cycle at that point. And I think that's the point where it's a kind of a make it or break it. If you don't fund the policies anymore, then cool, that's fine. But I think what's probably going to happen is you get that windfalls and you're like, oh, yeah, let me just fund the policies the remaining of the 3 years. And now you're set up.
I like it. That makes sense. Cool.
Yeah. But bare minimum 130. And I think what most people do is like they get a small policy. Like when I first started to do this, I did a $50,000 policy every year for 6-7 years. And then it was just cool to use it and be like, oh, this is like a HELOC. Oh, what is that thing on my portal? It's saying I owe $5,000. Oh, that's just the interest. I don't care about that because my cool friends actually know about money. Don't freak out about it. And then you add a 0 on top of the end of it once you get the hang of it in a few months. So you withdraw money, you pay it back. And then some people in the family office group are doing this, like instead of getting the loan from like Ameritas, Penn Mutual, Guardian, they go to a third-party bank. Instead of paying 5%, they pay 3%. If you're doing a larger policy like how you are, something like that adds up. 1% on 600 grand adds up. But yeah, that's the IBC thing for you. And I think if you want to play it more conservative and only go into a few deals at the minimum on the investing side, I'll play it more aggressive on this stuff.
Okay, that makes sense. Yeah, and I think as far as the investment side, like I'm willing to ramp it up once I feel more confident in how I can vet sponsors and deals and have a good network of people who have invested in the past. And
then also, like we said, you could really ratchet this up by getting more aggressive on the withdrawals from your IRAs, right? Mitigate the higher income by conservation easements or something like that, if it's still around, if you're willing to be careful and work with the right people on that, of course. It's on the list of transactions. People freaked out. Oh my God, I Googled it. And it's like, this is naughty. I'm supposed to do it. I don't personally do it because I've gotten to the point where I don't have active income. It's all passive. And that's where you're going to get to at some point. But how can we bridge you to that promised land in 5 to 6 years when most of your stuff is passive, so it can offset the passive losses? Okay, we got a plan on the IRAs a little bit. This is a good call. Your situation is confusing, and there's a bunch of things moving around. Talked about IBC. Let's talk about like lifestyle changes, because that may increase your. If you sell that, you're gonna stay in that house you guys live in now, or downsize, or.
The plan is to try to sell. I'm a little bit constrained in that a lot of our family is close by and they're the ones helping a lot with the kids now, and they're in a good school system. And so like I can't just pack up and go wherever. So I'm a little bit constrained, in the market where I live is quite hot, which is a double-edged sword in that I think my house would go pretty quickly for a good amount without having to do a lot of work to get it ready, but then I have to find something to replace it with. But yeah, the ultimate goal is like our house is a decent size, a lot of land, and just way more work than I need. And it's too big for just one adult and 2 kids. So that's definitely something that I want to do, is downsize, get some equity out. And that would also have the function of reducing my payments, monthly mortgage payments anyway.
Yeah, I would just say you don't need to downsize. Like some people, I'm like under $500,000 net worth. I'm like, dude, this is stuff you need to do. You're already behind in the game. Right? You're already in your 40s and 50s. You have to do this stuff. But for you, you can keep living there. That's cool. Again, they say you never want to listen to whoever the heck they are, but they say don't do anything like drastic for the first year, whatever. But I will say that, speaking from the experience from some of the other folks who've downsized, they've gotten away from living in the big house and they've gone to more of the luxury condo where now they enjoy it because now they're hanging with their kids. They got the pool. They don't have to clean.
Mm-hmm.
It's just simpler living, less headaches, nothing breaks. So if you're going to the more simplistic life, that'd probably be the way of doing. That's not a bad way of doing things. Actually, personally, I think I might like the condo life a little bit better, less nonsense. Don't have to clean my own pool.
That's how I'm looking at a condo or townhouse where there's community pool and they take care of all like yard maintenance, and it's just. And again, just getting back to the simplifying things, like it's become clear, like I don't need a lot of stuff. I just want time with my kids and the possessions that I have, enjoy and travel and do fun stuff. So
in that primary residence you have now, you got about $500,000 of equity in that thing?
So it will depend. So it was a 0% down because we had a physician's loan, which was nice. And we only bought it just under 6 years ago, but the market's gone up so much that I've talked to a couple different agents and looking online, it would probably be between 350 to 400. Depending on what it sells for, is about what the equity that we would get.
So one thing, this is a tax thing, right? Like you're only able to write up, like be exempt from what, $250,000 of gains?
So that's what I thought too, because it's just me now. But my CPA said within 24 months of my spouse passing, I should be able to get the full $500,000.
So you're not maxing that out yet. You're almost.
Not quite, but yeah, if I stay in this house for another couple of years, then I'll be above the $250,000 max for myself. Because then it's going to revert to it's just me. It would just be the individual too.
Yeah, I'm like, it kind of is a good tax move because you have.
Yeah, it's something I wanted to do actually even before this happened. I had already been talking about. Hey, we should downsize. We should simplify. So if the right house comes along that I can get, I think I'm going to do it, and that's yet another windfall and more cash that I can deploy.
Yeah, because if you don't move before the year 2, you lose that double tax exemption thing.
Exactly. Yep.
Yeah, for me, I mean, I don't want to push you either way, before I heard that, I'm like, yeah, you got to just move out and buy it back again if you feel that's what you want to do. I don't know if you can do that. It's not like a wash sale, but you know what I mean.
Yeah. No, I think it's a strong possibility, and even where we live, it's more of a isolated subdivision, and there's not as many kids around, and there's plenty of neighborhoods where a lot of their friends from school are that would be cheaper and smaller and have a lot of the things we talked about. So yeah. It's definitely on my radar, and that would just accelerate what we talked about and give me more cash to put into these funds.
Yeah, but maybe think about it, and I think wait till the springtime or summer. That's when the market is supposed the hottest. The world doesn't end before then.
Yeah. No, I got my like I'm looking now to potentially hop on something if somebody's putting something on in December or January. But my goal is to probably list my house in the spring because that's just
Yeah.
it looks the nicest. It's the hottest market.
But if just doing some quick math here, if you dump out 400 grand, you put it into an even bigger infinite banking policy, or you just do an infinite banking right away at 5%, that's 20 grand a year, a couple grand a month. You always want to do this equation and think, how does that 2 grand a month change my life? If you had to use it, that could be a lot of less home cooked meals and eating out, less more time, right? If you can use that $2,000 every month, that is time, or for time, that's money well, or that's a good move to create that cash flow, and that's everlasting cash flow. That's not just eating through your pile. That's how I would look at it. So you get to live in the condo, get the free maintenance on the pool. But what are the downsides of that? I don't know. Is there a downside in your head?
The only downside is less privacy. Like the lot I have, it's great private lot. It's gorgeous. Like you're by nature, and it's very private and very nice. But
Spend
I think the positives of moving outweigh it though. Like just simplifying life, getting a bunch of equity out and redeploying it.
Yeah.
Getting my kids in a neighborhood with a bunch of their friends, I think definitely outweighs the privacy concern.
That's why I asked, because some people, when they talk to their spouse, they're like, well, what's the downside? And they can't communicate because there isn't, they just don't want to do it, which is silly. You've obviously been able to voice your concern, which is privacy. But so what if you took $2,000 a month and you bought the penthouse instead of the other one?
Right.
But you rented the penthouse instead. $2,000 pumps you into a much higher, more exclusive community. So think about it like that. The term life, if you get that big of a policy, you don't have to pay this anymore. So that frees up some more cash flow.
That's true.
That's redundant. Yeah, I think we covered a lot here. Anything else you wanna?
No, I don't think so. This was very helpful. Thank you. Hopefully it was helpful to people listening. And then I will definitely check out that e-course on the infinite banking.
Yeah, I think trying to think what is the first domino that's got to fall here, but the house, there are 3 things. Moving out of the house, I think you can delay that to the spring or summertime. So that's third on the list. You already have liquidity, so you could probably, and then you don't have to do the taking out of the retirement accounts quite yet. It's a rare situation, but infinite banking seems to be the first domino here, which if you're listening on the podcast, that's typically not it. If you're screwing around with infinite banking, stop doing and wasting your time, especially your net worth is under $1 million. You haven't invested in anything.
Yeah, I agree though. In this case, it makes sense because it gives me a little bit of time to deploy some of this extra capital, and then I can get spun up on what syndications I want to invest in, educate myself. The house can come later in the year, and then slowly peeling away some of that retirement stuff can start happening at any point in 2022 once I have a better idea of my adjusted gross income as well, and then decide how much I'm going to pull.
Yeah, and I think once you get moving down the road, once you deploy $1 million, you should be making a fraction of your salary, and then when you double that, you should be able to start to see the light. Once you deploy about $1 million or $2 million, you should start to see the light on when exactly you're going to quit.
Cool. Yeah, that dovetails nicely with where I'm at now. Again, the place I'm at, it's a lot of fun to work at. I enjoy it, but reading the tea leaves, I think 4 to 5, maybe 6 years at the most, I should be done doing what I'm doing and then be ready to.
You ride out the startup for 5 years, but you don't want to go back to practice.
I don't want to do like the typical family practice, seeing 20 patients a day every day. That's too much. I wouldn't want to do that. But it's something like that. It would be part-time, or it would be like part-time remote. There's a lot of remote providers where you can work anywhere you want in the world and do telehealth. And I could do that part-time and supplement with my passive income and still have a pretty nice lifestyle.
Yeah. I think you'll have enough at that point where you don't really need to make 150,000 a year part-time, type of thing. Yeah, but I know you'd be in coast mode, going 70 miles an hour at that point. But then we'll see in the next several years. We'll see if you get bored or not. You wanna?
Yeah, that's the thing. Like I do like healthcare. It's fun working in healthcare, and the U.S. healthcare system is so broken. So if there's cool projects or companies to work on to try to fix stuff, like that interests me. But it would be nice to be in the position where I can decide which project or work I want to take on, and if there's nothing that's interesting or exciting or worth the work, I can.
Yeah, the current employer, the startup thing, is it pretty time intensive or is it?
It's hit or miss. It depends. So it's actually like some days are less than others. It comes in fits and starts like a typical startup. So it's not a lot of patient care for me. I'm doing a lot more project work and data work and all sorts of things where sometimes a big project comes along and I'm spending a lot of time one week and then the next week it's relatively slow. If that makes sense.
If, with you being the primary caregiver, I would manage if you can't handle it, you need to step back, you could.
Yeah.
If you stuff all this money into infinite banking and you get maybe $250,000, $500,000 into deals making 10%, you probably have enough to definitely sustain your cost of living if things get too busy. You have the option to
do that. Yeah, right now it's not too bad. And the good thing is most of the time I actually get to work from home, which is nice. So even if it's busy, I still have the time with the kids. And then a lot of the work I can do at night when the kids are asleep, just the nature of the startup and how I'm doing it. A lot of it's project work or things I can literally do at 10 o'clock at night while they're asleep. I can just sit there and get my stuff done. So it's actually not too much of a hassle. And we have a lot of family nearby that spending time with the kids and watch them a lot and hang out with them. So far, I think I'm in a good spot, at least for the next couple of years. If things stay.
Is the family decently well off, or you guys the more wealthy folks?
The rest of the family is pretty well off, at least the ones close by. So like my mother is about ready to retire. Like she does pretty well for herself and she's transitioning. She's going to probably transition to working part-time. She's close by. My wife's parents, not super well off, but they're fine. Like they're the ones actually in that long-term rental property we have, and they're paying well below market rates. So that's when we're basically, it's cash flow negative. Like we bought the property, they're paying the HOA and the mortgage. It's cash flow neutral for us, but it's building up equity and it has them in a nice spot, basically under market. So that's like a win-win.
What is their long-term, like?
They're going to stay.
They're going to age in place.
At least for now, yeah, they're healthy enough and doing well enough. I don't think there's any imminent plans for them to go to assisted living or anything like that. And then also my brother-in-law lives close by as well, and he has his own like marketing company and does pretty well. So
not I live in mom's basement, steal her check.
No. Yeah.
Okay, good. Yeah, because some of the people they're like obviously the most wealth in their family, so they have to also keep in mind the providing or in a way.
No, thankfully everybody else in the family is fine.
Yeah, everybody's got their stuff together, so that's good. That's good. But yeah. Anything else, Derek? You guys want to go over or?
No, I don't think so. I think that was very thorough and super helpful. So thank you.
Cool. Yeah, folks, if you guys like this, or you guys want to volunteer this stuff, shoot the folks an email, team@simplepassivecashflow.com. And if you haven't yet, join the club. Book your free onboarding call before I start to outsource it out to the team. Won't go in as in-depth into this type of stuff, but we'll try and knock it out in 15 minutes or 20 minutes or so. This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.